Hi there. Welcome to The Street on BNN Bloomberg. I'm Lindsay Biscaya. Coming up on the show today, Tyler Morty, CEO and CIO at 4Strong Global, is joining us for the hour. And then in 30 minutes, we will be joined by the founder of Goal 17, a new Canadian-built privacy-first AI tool that's rewriting the rules on ethical AI. And we, of course, want to hear from you this morning on our first call segment. You can call us with your questions about global investing with a macro approach, and we'll have Tyler Morty answer as many of them as he can at the end of the show. The number to call, 1-855-326-6266, and we will open the phone lines in about 30 minutes from now. And our email also on the screen right now, firstcall@bellmedia.ca. And now here's some of the stories we're tracking for you in the BNN Bloomberg newsroom. Shares of BCE are edging lower in pre-market trading this morning. The telecom giant posted profit in its latest quarter that beat estimates, but saw operating revenue fall below expectations. BCE says it expects higher revenue and profit driven by improvement in wireless pricing, a boost in product sales, and growth in its AI-powered segment. And a reminder, BCE is the parent company of BNN Bloomberg through its Bell Media division. Barrick Mining says it will spin off its top North American gold asset into an IPO after naming Mark Hill as CEO. Now, the world's second biggest gold producer plans to include interests in Nevada and the Dominican Republic in the spinoff, with assets worth as much as $62 billion. Barrick will sell a minority stake in the new company, but will retain significant control. And shares of Alphabet are down in the pre-market despite posting better than expected revenue and profit in the fourth quarter. Investors are wary after the tech giant announced it would be almost doubling capital spending this year. Alphabet says the boost is part of its continued bid to build infrastructure for artificial intelligence. And now our top-line story. Barrick Mining, BCE, and Canada Goose have all reported this morning, while Alphabet's earnings are moving the pre-markets as well. So to take a closer look at the numbers and what it means for your portfolios, we're going to bring in our guest for the hour, Tyler Morty, CEO and CIO at 4Strong Global. It's good to have you in studio. Thanks for coming in.
Lindsay.
Good morning.
To be here. Yeah.
So a couple of different earnings to go through, and we'll obviously expand this out and talk about what this means for the broader market. I want to start with Barrick Mining, though. Strong results coming out this morning. They reported at 6 a.m. There's a spinoff now of its North American assets. I wonder what you think this means for like the larger gold mining industry and copper mining.
Yeah, I mean, no surprise that Barrick Gold, being one of the leading gold majors, would report great earnings. But I think from a macro investor perspective, we're looking at the top line gold price and looking how that impacts the earnings of these gold majors. And obviously, we've seen a huge surge in the gold price over the last 12 months here. And so it shouldn't be a surprise here. I think the focus with the gold mining sector is how do the costs rise as the gold price rises as well. And so, the big input into the gold mining sector is obviously the price of oil, right? That's a huge input.
Okay.
Right.
Can you explain that a little more?
Well, if you look
how
at
the two connect.
If you look at the industry itself, the extraction process is very energy intensive, right? So oil would be a huge input into the gold mining sector. So, looking at Barrick and looking out, we should see that the gold miners are spinning out huge free cash flow. It should be a good year for gold majors all around. And no surprise on those earnings.
And it's been boosting up, like the companies. I saw a stat this morning on Bloomberg that said Barrick Mining's stock price has gone up more than 50% in the last 3 months. And a big part of that is because of the price of gold that we've been seeing just going up. And right now it's up and down.
Yeah.
I guess we're going to continue to see a bit of a roller coaster with gold prices, maybe.
I think there's going to be volatility. Like if you look at the price of gold, like 2 Fridays ago, we saw the GLD ETF. We saw the largest volume ever traded on that ETF ever, right? So we've had a whole slew of attention, lots of speculation.
Mm-hmm.
Some people say that the gold price has been memeified, for lack of a better word, and so gold prices are they've got this speculative aspect, but they've also got like a lot of underlying fundamental drivers, right? We've got the foreign central banks that now hold more gold than U.S. Treasury bonds. We've got the Asian consumer, which is very excited and enthusiastic for the price of gold. And if you think the world is going to become more sane in the next few years, then
think again, maybe.
Think again, exactly. So the gold price is well supported by a number of fundamentals.
Yeah.
And so again, back to the gold mining sector, it's all about if you look at the business model of gold stocks, it's all about the top line price, which is obviously gold, and then the bottom line cost, which is oil, all the input costs and that type of thing.
Interesting. Okay, so we're going to move on. BCE, another company, of course, as I mentioned, the parent company at BNN Bloomberg, beat estimates, sees 2026 revenue growth on AI potential. So AI seems to be a big focus for a lot of companies, including BCE. It says 2026, our focus shifts to execution. Do you think that's kind of the story for a lot of companies? We saw spending in AI in 2025. Now people want to see results from that spending.
I think so. I think that's a big story. Like, just to back up, if you look at what we've seen since October 29th, we've seen whenever the tech majors actually spend a lot on AI, the market doesn't like that, right? The market actually takes the stock down. So I think the second act of AI, if you will, is all about, okay, we've spent all this money. Let's start to see the monetization. Let's start to see the profits going to the bottom line. And in the case of BCE, I think if you look at, to use this term, the second act of AI, if you look at this, we're starting to see a focus, and this is typical for any sort of innovation boom. Typically, you see retail really crowd around a certain level of stocks. Like, right now it's been the hyperscalers over the last year. And then the second act is, okay, where do we see productivity? Where do we see innovation? And how does that filter down into the actual companies? So I think AI as a macro trend, if you will, it will now start to filter down into healthcare, into communications, into energy, into financial services, all these types of sectors, and that's what we're looking for. But it's admittedly it's a broad amorphous trend. Right. Like it's very difficult now. Retail loves to say, okay, we've got these specific stocks, NVIDIA et al. And then now we're looking at the second phase, which is, again, more vague. We have to look at, where the productivity actually takes.
Rolling it out.
Exactly.
Yeah. Okay, we're going to take another quick break right now. But up next, we will take a look at the markets before the bell. So stay with us. Welcome back. We'll take a look at how things are shaping up on the markets, beginning with the U.S. futures. All trading down ever so slightly this morning, the Dow, the NASDAQ, and the S&P 500. If we take a look at how major Asian markets finished the day today, lower as the tech sector concerns weighed on investors there. The Nikkei down by 0.8%. Hang Seng up ever so slightly, and the CSI 300 down by 0.6% to end the day. Moving over to Europe. Of course, the European Central Bank decided to hold rates steady today, so we're seeing markets reacting to that news, all pointing downward. The FTSE, the CAC 40, and the German DAX reacting to that news today. Here at home, if we take a look at where the TSX finished the day yesterday, it was up by about 0.5% to end the day. If we take a look at the biggest winners and losers yesterday on the TSX from a percentage standpoint, Constellation Software was the biggest mover yesterday to end the day, up more than 8%. West Fraser Timber up more than 7%. Bitfarms down by 12%. Energy Fuels the biggest lagger yesterday, also down by more than 12% to end the day. And we'll take a look at the price of metals this morning. Gold is down by more than a percentage point, almost 2% actually. Silver hit with a fresh sell-off as well, particularly in China, plunging as much as 17% earlier today, now down by more than 9%. Copper also extending losses as investors focus on rising inventories there. Copper down by more than 1% at the moment. And if we look at the price of crude oil prices dropping today as well, down more than 2%. Of course, Iran has confirmed it will hold negotiations with the U.S. Hopefully has come up with an actual location now, and that is, of course, moving oil prices down. While many Canadian portfolios are often U.S. heavy, our guest for the hour, Tyler Morty at Forest Strong Global, is looking to international markets for opportunities. And he, of course, is in studio with us today. So we talked about this right around the new year, that international markets are kind of what you're looking at for 2026. Why?
Yeah. Well, if you go back to the last year, our big thesis at Forest Strong has been that when Trump started this trade war, if you look at the implications for the rest of the world would respond. Like if your exports are under attack, Lindsay, what do you actually do? You try to stimulate your own domestic economy. You try to protect your export market. You try to do all these things. So our sort of catchy phrase there was the protectionist paradox. Like the paradox was that, going into and backing up to 2024, when you look at the end of 2024 and the views going into 2025, most folks in the market thought that if you had this Trump administration, you'd have a continuation of what you saw in the last decade, which is continuation of U.S. outperformance, a strong U.S. dollar, those types of things. And so that didn't happen at all last year, right? If you look at Europe, Germany announced a massive fiscal package equivalent to like 11.2% of GDP. You look at China, you look at the wider Asian complex, fiscal stimulus was the main event of 2025. And therefore, we saw interest and renewed stories come out of these international markets. So, if you look across the board, international markets have perked up. They've broken out. You look at any sort of technician, any chart over the last year. We've seen Japan break out. We've seen Europe break out. We've seen China break out, which has been sort of left for dead.
Yeah.
So the international markets I think they're back. And it's been a long bear market, right?
It's super interesting, especially when you look at that in comparison with the U.S. markets, right? If you were looking at the European markets, is there a certain sector that you think does better in that region? And then we'll talk about Asia.
Yeah. So within Europe, I think a barometer, if you will, of risk appetite, of sort of enthusiasm towards a sector is always the financial services. So at Four Strong, we love the European banks. We've been long those banks for a few years now. They've done extraordinarily well over the last year. But you always look at financials, in any bull market, you always look at if financial services are leading, that's a very good sign, right? So within Europe.
Why is that?
Because, again, it's a barometer of the overall risk appetite. If banks are doing well, lending is doing well, employment's well, it sort of feeds into the overall.
The economy's doing well.
The economy's doing well, exactly. So Europe is undergoing a classical cyclical recovery. Forget about all the strategic issues. Like, over the last decade, everybody knew that Europe was sclerotic. Everybody knew that Germany's auto sector had an issue, all those types of things. But if you look at what's actually happening now within Europe, it is a virtuous, classical, traditional economic cycle. Unemployment's going down. Interest rates have fallen. The ECB has cut, 8 or 9 times now. Bank lending is turning up, and importantly for the stock market, corporate earnings are finally turning up, which is something that we never had for a long time. So for a long time, you could say, well, international markets are cheap, and therefore you should invest in them. But we never had those catalysts, and those sort of arrived in 2025.
Interesting.
Yeah.
What about the Asian markets, and particularly, like you were talking about China off the top? Is there a certain area that you like, or what does the economy look like?
Well, in China, if you back up, uninvestable and China became synonymous in the last few years. And so what we say at Four Strong is you're not investing in the Chinese government. You're investing in Chinese consumer companies. If you believe in the domestic middle class in China, then you should look at these companies. So for us, it's the consumer internet companies. It's the same thing. If you think about the Mag 7 in the United States, there is effectively, we don't have an acronym yet in China, but there is effectively a Mag 7 in China as well, which is Tencent, Alibaba, all those types of firms that do the same things that Facebook, Twitter, Google, all these companies do. So, and they trade at a fraction of the cost of the Mag 7. So,
are people worried though? As you say, you're not investing in the Chinese government, but the Chinese government does have a lot of stakes and some ownership behind a lot of these companies. Is that something you hear people concerned about if they're looking at investing there?
I think that is a concern, like the state-owned enterprises, as you're talking about. Yeah. I think that is an issue, but I think we live in a crazy world, obviously. And people look at the Chinese government. They've got this very clear industrial strategy, which is AI, which is trying to move up the value chain, which is trying to stimulate the domestic middle class and not rely on exports, all these types of things. And I think people see some predictability with the Chinese policy, and that's sort of a welcome relief.
I wonder if people are looking at Europe, if they're looking at Asia for investment opportunities, where does that leave Canada?
I think Canada is pretty well positioned, right? Because Canada has a strong correlation to emerging markets. A lot of people don't actually realize that. But Canada, we are a bit of a two-trick pony here. We've got the financial services, obviously, and then we've got the commodity companies. So for us, if you look at Canada, tell me where commodity prices are going, and I'll tell you where the Canadian stock market is going. Like last year, again, this was another example. Nobody had anything good to say about Canada. Right. We host these investor events right across Canada. and we took a poll about who was bullish for Canada in 2025, not one person raised their hand, right? And so we talk about politics, we can talk about the consumer debt load and that type of thing, but Canada did well last year, and that's a largely a result of the price of gold and commodities.
Okay, we'll leave it on a positive note for Canada then. We'll take another quick break, but of course, Tyler's sticking with us. And right after this, we'll be back with Tyler Morty to see what ETFs are on his radar, so don't miss that. Stay with us. Welcome back. Time now for On the Radar, and we're back with Tyler Morty, CEO and CIO at Four Strong Global, to go through some of your picks. So, Tyler, we'll start with the first one, Global X Copper Miners ETF. Now, we were talking a little bit about ETFs in gold and copper earlier. What is it you like about this one?
Just broadly, we love the commodity complex. And if you think about the big commodity stories over the last, and I'm going back 50 years, we had a commodity bull market from 1968 to 1980. We had a commodity bull market from 2001, 2002 to 2012. And the makings of a good commodity bull market are always a lack of supply, right? You get a rising price, you get a lack of supply, and then you get the actual companies investing in capex and that type of thing. So the copper story is at the heart of electrification. It's at the heart of decarbonization. It's at the heart of reindustrialization. Right now, like everybody knows, the world is fragmenting. Yeah. So everybody's retreating to their own industrial strategy, recreating supply chains, all this type of stuff. So the copper miner ETF supplies exposure to the world's leading copper majors. So a lot of it's in Canada, about 34% in Canada. Wow. But then it goes right across. There's some in the United States, there's some in emerging markets, there's some in Asia and so forth. So it's an ETF with good leverage to the copper price. And so we bought this for clients late last year. And obviously it's done very well, but I think it's a multi-year story. Right?
And copper, like we're seeing the price down a little bit right now, but obviously, with the lack of supply and the demand that we're going to see for copper increasing, like you feel that the copper prices are going to be strong.
There hasn't been a commodity story in a very, very long time, right? There hasn't been, think about all the capex. Like I think about the oil sector, for example. In 2012, there was $1 trillion spent in oil capex. That obviously is not the case for oil, but it's not the case for copper. It's not the case for gold. It's not the case for anything really in the periodic table, right?
Right.
So I think it's good leverage, and it's got all these sort of macro tailwinds for a very long time. And it's largely everybody's been back to our earlier comments. Everybody's really been obsessed with the Mag 7 technology, that type of thing. And so we call this sort of the revenge of the real economy. The real economy is coming back, and people are taking notice of this.
Interesting. All right, your next one, iShares Europe Financials ETF. What is it about this one?
Yeah,
that you like?
So this is, as we talked about, Europe is in a classical cyclical recovery, right? All the makings of what you would want. So the Europe Financials iShares ETF supplies exposure to Europe's largest banks. It's market cap weighted. And if you look at the European financial sector right now, and you look back what it went through over the last decade, everybody knew about the Eurozone sovereign debt crisis in 2012 and 2013. Europe deleveraged very hard after the global financial crisis in 2008. Yeah. And it was a terrible place to be, the European banking sector. Now what we're seeing is the return on equity is actually higher in European banks versus the US banks. We're seeing the shareholder yield, which is the combination of the dividend yield and the stock buybacks, is better than US financial services as well. And investors have taken notice, right? It's done incredibly well the last few years here. So we've held that for clients, and it's been a good place to be.
So we've talked about commodities, we've talked about Europe. You're very organized because your last ETF goes over China and the Chinese market, right?
We move it right across the world, right? Yeah, exactly.
Yeah.
Exactly.
So the Crane Shares CSI China Internet ETF.
Yeah. So we talked a little bit about this, but this one supplies exposure to the major consumer internet companies in China. And as I mentioned earlier, it's sort of think about the companies like Facebook, Twitter, Google, et cetera, that are in the American index. And if you want leverage to the Chinese middle class, which is rising and which has been rising for a very long time, then these companies are well positioned. And I think the most interesting thing is, they're, as we talked about earlier in the show, they're integrating AI into their business models as well. Yeah. But you can buy these things at a fraction of the price. Like the trailing PE, price earnings ratio, over the last year is about 17. If you look at the Mag 7, you strip out Tesla, it's about 34. So you're getting about 50% off discount on on these companies that effectively do the same thing for a different population.
These are the almost kind of Asian equivalent of the Mag 7 is what you're talking about.
Exactly.
Yeah. Wow.
Yep.
Interesting. Okay.
Yep.
We're going to take another quick break right now. But when we come back, we will be talking about AI. We're going to be joined by the founder of Goal 17, a new Canadian-built privacy-first AI tool, which is rewriting the rules on ethical AI. And our phone lines will open soon for our first call segment as well with Tyler Morty. You can call us at 1-855-326-6266, or you can send us an email at firstcall@bellmedia.ca. Prime Minister Mark Carney is set to announce new electric vehicle policies today. According to Bloomberg, Carney is also expected to announce a revival of the popular EV rebates program, which was halted last year. The new policies will be part of a broader automotive strategy that aims to keep manufacturing jobs in the country and provide better market access to companies that build in Canada. Shares of BCE are edging lower in pre-market trading today. The telecom giant posted profit in its latest quarter that beat estimates, but saw operating revenue fall below expectations. BCE says it expects higher revenue and profit driven by improvement in wireless pricing, a boost in product sales, and growth in its AI-powered segment. A reminder, of course, BCE is the parent company of BNN Bloomberg through its Bell Media division. And Barrick Mining says it will spin off its top North American gold asset into an IPO after naming Mark Hill as CEO. The world's second biggest gold producer plans to include interests in Nevada and the Dominican Republic in the spinoff, with assets worth as much as $62 billion. Barrick will sell a minority stake in the new company, but will retain significant control. The company says the new listing is expected to be complete by late 2026. We'll take a look at the U.S. markets very quickly. In the pre-market, all trading down at the moment. The Dow down more than 0.3 percentage point, NASDAQ down 0.8%, and the S&P 500 also down 0.6%. And as more companies adopt AI, one concern keeps coming up: who actually owns the information being fed into these tools? Goal 17 is a new Canadian-built platform taking a different approach, putting privacy and data ownership back into the hands of the user. So we're joined now in studio by the company's founder, Aaron Williamson. And of course, Tyler Morty is still here. Aaron, it's good to have you in studio. Thanks so much for joining us. This is an interesting conversation. I'm wondering, do you feel like enough people are talking about the ethics of AI?
It seems like it's the side conversation, if it happens at all. You hear things about all of the bad outcomes from AI that might happen, and then we move on to how great it is and we should build more data centers.
Push it to the side, right? Yeah. So what was the main problem you were trying to solve when you created Goal 17?
So my work for years has been in strategy and decision making, and the larger the organization, the more distributed the knowledge is in the organization. I started playing with AI to see if that could help speed up the flow of information within groups in a strategy process or a decision-making process, and very quickly ran into the fact that most of the organizations I was working with weren't allowed to use any of the tools because they were either seen as insecure or didn't adhere to any of their data or privacy policies.
Interesting. I wonder, how is Goal 17, for people who maybe have not heard of Goal 17 yet, how is it different from tools like ChatGPT, Gemini, other AI systems?
So from the use perspective, I heard you saying earlier that we're in the phase of AI trickling down into actually useful use cases in organizations. I think that's the first piece. A lot of those tools that you mentioned are very general, and they're kind of meant to do anything. And what you see happening in the Chinese market, for example, is they're taking a much more focused approach on how do you get containers on ships faster or things like that. So this is a much more focused application. I would call this applied AI. So.
Yeah, I think that's an interesting point. I guess my interest from a global investing perspective is how is AI perceived differently within the different jurisdictions? For example, China, we had that big DeepSeek moment last year where everybody freaked out and we had a sell-off in some of the big American hyperscalers and that type of thing. And so How is I assume you look globally and look at how the interaction is happening there. How is the perception of, let's say, and I know China is pursuing a very different strategy, which is all about monetization and efficiency and diffusion, to use that word, whereas America seems to be focusing on innovation and having the best large language model. Like just that's sort of a broader question, I know, but like, how do you see the different jurisdictions interacting with each other?
Yeah, so a lot of my work is in Europe, which is a big part of what shaped this decision, is there was obviously a lot more concerns about privacy in that market than there is in the North American market. But obviously the events of the last year have shaped it a lot as well, which is that with all of the threats from the US administration on all of its allies, what I'm seeing in Europe is one government after another making declarations about getting off of the US tech stack and moving to open source software.
Yeah.
When it comes to people's data, like I think a lot of people, the idea of your data being used or sold is very scary. I myself choose to put my head in the sand and not think about it because it's very scary. But for Goal 17's goal of trying to keep that data private, where is it stored by Goal 17 and how is it stored?
So we have two flavors. One is just in Canadian data centers and making sure that all the data stays here. But a lot of our work is in kind of sensitive intergovernment negotiations. So, for example, Crown Indigenous participation for some of the kind of major projects that are going on. In that case, it is literally in the box. All processing happens inside a kind of carry-on compatible data center that you can take on the plane with you.
Oh, it's like a physical box.
Which has helped to explain some of the privacy things in some contexts. I think people glaze over when you start talking about where your data resides and everything. When you can point to a box on the table and say, the data doesn't go anywhere, that's something that you can wrap your head around.
Interesting.
Yeah.
So that's the product itself. It's actually a piece of hardware that you've designed with your company.
Yes.
And you bring it to the organization or the individual, and it's how and what's the install like on that? Is it like? Is it literally okay?
So for example, in like a strategy process or a workshop or something like that, it has a network of kind of audio sensors that bring in all of the data, and then it kind of surfaces the insights as people go through the process.
Very precious box then.
Yeah,
Obviously, there's a lot of security around
That's
that.
why it's check-in, not checked luggage.
Yes, you keep it with you at all times. When it comes to the industry as a whole and how the industry is working around privacy data, do you think most companies are moving in the right direction or closer to the wronger direction, or is it maybe just not a priority?
We're in a real pinch. I think if you hear people talk about digital sovereignty, Europe is a bit ahead of the curve on that. I think there's a bit of a panic situation all the way up to the satellites they're using. If you look at Canada, we are very dependent on US technology companies. Even when it's sort of a Canadian cloud, it's still an American company running it. So our options are fairly limited, and our government is almost entirely on US data providers. So there's a bit of a rush to figure out how do we make any kind of sovereign tech.
Yeah.
So this is a Canadian company. It's founded by you. You've designed this technology, and when we look at sort of our market and trying to reach international markets, where do you see the highest sort of ROE that you could do with this company?
My first sales have all been in Europe.
In Europe, okay. So Europe
and I think that's Canadian technologists have always looked to the U.S. We're very tightly integrated with the U.S. I have previously been very tightly integrated with the U.S. I think there's a reluctance to move away from it because of so much of our capital comes from the U.S. But I think it's worth Canadian innovators knowing that there's a huge market in Europe that is open to Canadian products.
Is the hope as well to expand, further into Canada?
Absolutely. Yeah. Canada first.
Okay. I'd like to hear that.
But Europe is a great market.
Right.
So interesting. Okay, that's all the time we have. Really appreciate you coming in studio and breaking that down for us. Thanks so much.
Thank you.
Still ahead, Shell profits slumped in the fourth quarter, undershooting expectations as lower crude prices and a struggling chemicals business dented earnings. Our colleagues at Bloomberg spoke with Shell Chief Executive Officer this morning, and we will bring you that next. Plus, our phone lines are open now. Tyler Morty, CEO and CIO at Four Strong Global, is taking your questions on global investing with a macro approach. You can call us 1-855-326-6266, or you can email firstcall@bellmedia.ca. We'll be right back. Shell's chief executive officer joined Bloomberg's on the opening trade to talk about the company's performance as its fourth quarter profit slumped, undershooting expectations. Let's take a listen.
I'd say we've had a strong 2025 trading overall. The fourth quarter typically is softer when it comes to both products and crude trading, but we've had, by and large, another strong trading year. And I would say at the end of the day, our ability to be able to create value through trading depends on, of course, macro conditions, depends on fundamentals. It is one of the strongest differentiations in Shell, I think, compared to our peers, and one that we continue to see a lot of running room. But beyond trading, I would say this was also a very strong operational year for us overall. If you look at the entire year, we delivered $43 billion of CFFO in what was a $10 drop compared to 2024 in oil price. And we've been able to really do what we had promised to do, take out costs, $5 billion plus of structural cost reductions, continue to be disciplined in capital spend, and high grade our portfolio. So overall, a very good year.
Do you share the view that this is an oversupplied market and that dynamic continues this year?
We see that there is indeed a bit of oversupply at the moment, but that, I would say, is balanced with the significant uncertainty that we are seeing because of the geopolitical challenges, whether it is earlier in the year Venezuela, more so now Iran, the instability with the Russia-Ukraine crisis that continues to play out, and so on and so forth. So there is a premium with that uncertainty and volatility. At the end of the day, the one thing we do know is we have no clue where oil prices are going to go. So we really focus on our fundamentals, on the cost structures, on how we allocate capital, on how we continue to build that performance muscle. Because the last 3 years has been all about creating that performance culture. Now we need to step it up a gear and make sure that we take it to the next level of excellence.
Good morning to you, Wael. And as a result of all of that, you plan to return cash to shareholders. You're announcing $3.5 billion in a buyback today. How should we think about your strategy around buybacks? Because might you be challenged in getting to your return to shareholders targets for 2030? And if you are challenged, would that be because of weaker oil prices or because you want to do other things with the money? Maybe there's more focus on portfolio exploration.
Yeah, great question. I'd say we start off by not being dogmatic on where our capital goes. We really want to unlock maximum value for our shareholders. And what we see at the moment is that from a distributions perspective, we are preferentially allocating capital to buybacks because we still see a very attractive buyback in Shell. Our free cash flow yield continues to be very attractive. We see a great runway. We have a line of sight to 10% free cash flow per share growth every year between now and 2030. So being able to buy back Shell, in my mind, is a very, very good investment. To give you a sense, over the last 4 years or so, we bought back a quarter of the company at an average price that's around 20% lower than where we are today. That doesn't mean that we don't continue to look at opportunities to be able to also invest, and that's what we did last year. $2 billion of our capital budget went into M&A, into what we would call bolt-ons in our deep water space, that contributes to our production growth in 2030 and beyond. So this is a very, very focused allocation of capital in pursuit of long-term shareholder value.
That was Shell CEO Wael Sawan on Bloomberg TV this morning. Still ahead, we will take a look at some of the notable analyst calls and recommendations moving the markets, including Microsoft. That's next. Stay with us. Let's take a look now at some of the notable analyst calls and recommendations. We will start with Microsoft. Shares are down in pre-market trading today after Stifel downgraded the software giant to hold from a buy. Analyst Brad Reback says the consensus estimates for 2027 look, quote, too optimistic. Stifel sets the price target to $392. That's down from $540 US. And after the bell yesterday, Alphabet reported earnings and sales that topped estimates for the quarter. Today, JP Morgan raised the target on Alphabet Class A to $395 from $385, maintaining an overweight rating. The new price target implies a 19% increase from last price. Alphabet in the pre-market, though, almost 5% down at the moment. And BMO Capital Markets analyst Sohrab Movahedi raised the recommendation on Brookfield Asset Management Class A to outperform from market perform, setting the price target to $79.30 Canadian, implying a 17% increase from last price. Brookfield Asset Management reported earnings and sales that topped estimates for the quarter yesterday. Former Prime Minister Stephen Harper has called for the Liberals and Conservatives to come together for the benefit of Canada. Current Prime Minister Mark Carney met with Conservative leader Pierre Poilievre. CTV's senior political correspondent Mike LeCouture has more on the meetings in Ottawa and Washington.
Good to see you. This is not hope. This is not hope over here. Well, look at this.
The Conservative leader with a dig at his Liberal colleagues ahead of a meeting with the Prime Minister.
We have been working to fast track anything that we believe, however modest, might make life a little more affordable, a little safer, and our economy a little stronger. So it's he that is holding up the show.
According to readouts from both leaders' offices, Carney and Poilievre agreed they need to work quickly to pass policies that will make life more affordable for Canadians. The Conservative leader also offered his help in Canada-US negotiations.
In fact, we need to work together.
Conservative MP Jamil Javani, meanwhile, is heading to Washington this week on a solo mission to improve trade relations between Canada and the U.S. He's a longtime friend of U.S. Vice President J.D. Vance.
I haven't talked to him in about a year about those issues. I would like to use that relationship for the good of the country, but I also don't want to interfere in what the Prime Minister's doing.
Javani was pushing for a meeting with the Prime Minister, but he did get one with the Minister in charge of Canada-U.S. trade.
Minister LeBlanc gave a briefing to Mr. Javani, who I don't believe is the trade critic for the opposition, certainly not the Minister of International Trade, nor the Prime Minister.
But some members of cabinet are casting doubt on whether Javani can or will help.
I really hope that he spoke about the closure of GM in his writing, because Ingersoll has been closed for now 4 months, and I haven't heard him once.
While a number of Conservative MPs are confident Javani can use his contacts to make a difference, Poilievre says he told his MP the most important thing is to fight for the jobs in his community. Mike LeCouture, CTV News, Ottawa.
When we come back, Tyler Morty, CEO and CIO at 4 Strong Global, is going to take your questions on First Call. That's next. Stay with us. Welcome back to the First Call segment now with Tyler Morty answering your questions today. We're going to go right to the phone lines. Nick is calling in from Toronto with a question. Hi, Nick. What's your question? Hello? Okay, I guess we lost Nick, but his question was about chips.
Chips.
That's all I know.
Chips. let's do 45 minutes on chips.
yeah. We can talk about chips, or we can move on to another email. But we can talk about chips.
I mean, I think obviously I'll take the global investing angle here.
Right.
And if you look at the key manufacturing spot of chips, memory chips, semiconductors, et cetera, it's in South Korea and Taiwan. Those are the two major countries that do the manufacturing. Pop quiz for you, Lindsay. The best performing emerging market last year, and some classify South Korea as a developed market, but was South Korea.
Okay,
right?
good.
South
You gave
Korea.
the answer. I'm glad.
I gave the answer. Yeah, no, I wasn't going to put you on the spot. But South Korea was the top performing. Taiwan. So if you want to play the AI, I mean, we talked about innovation in AI. That's important, but the more AI innovates, the more there's going to be the demand for chips, and the more this macro trend surges, the more there will be bottlenecks to produce these chips. So from a global investor perspective, for our clients, we're holding those two countries as well.
And like looser regulations, right? With Donald Trump kind of easing the imports and exports of chips from China, like that should ramp
accelerate
up the market.
Yeah. But I mean, I think the main point though is, there's such a developed industry in South Korea and Taiwan.
Okay.
It's very hard to replace that. Like bringing back the manufacturing back to the United States or bringing it back to Canada or Europe it will take a long time, and I think investors should not count on that. So look to the international markets to access the chip.
Got it. All right. That is our theme for today, international markets.
International markets.
We're going to go to an email now. This one coming in from Marie, and it reads, "Hi, I would love to know Tyler's thoughts on silver." And we were talking about, some of these metals earlier today. I don't think we did talk about silver, though. So
we didn't talk about silver. I mean, silver you can look at broadly as sort of a high beta version. There's another word for you, high beta, which means that if gold goes up, silver will go up a little bit more. If gold goes down. And we've seen that action over the last couple of weeks here. 2 Fridays ago, silver was down, 26%, and gold was down 10%. So that's
usually it does track gold, right?
It tracks gold pretty closely. Now, silver's got some more industrial uses than gold, which is primarily seen as more of a precious metal and more of a scarcity asset. But broadly speaking, our view at Four Strong is that the precious metals are in a bull market. Yes, some of these precious metals were memified. That's the new verb for you as well. They were memified, which means that there was a lot of speculation that went into them. We have the ETFs, we have the GLD, we have the SLV ETF, and they were able to run up, and we saw that parabola that happened in January. So, there's going to be a lot of volatility, but if you look at the fundamental drivers of precious metals, gold, silver, platinum, et cetera, the demand case is there. And as we talked about earlier on the show, the commodity story has been undersupplied for a very long time. So economics 101, surging demand and reduced supply should mean higher prices throughout the year here.
You did mention memified twice now throughout the morning.
It's my new verb.
It's your new verb. So does that mean, like you just explained it a little bit, but does speculation can really move the markets and move the price?
It means that like the cohort, if you want to talk about like the Robin Hood cohort in the United States or the millennial cohort or whatever you want to call it, they get really attached to a certain theme and really drive up the price, right?
Okay.
So I think all that does is create more volatility, which is fine. But we've seen that can work both ways. So.
Okay, interesting. All right, we're going to move on to another email, this one coming in from Jimmy, and it reads, "I'm intrigued by today's narrative on bullish views in observed market conditions with evidence supporting the thrust. With trading frenzy comes options trading, risk injecting, that old Trump pump and greed is good philosophy. Navigating long-term conviction with risk is preventing more volatility. Is this metals market looking really good for the next 12 years? I'm just going to stick with the last part of that email.
That's a good word salad. That's a good word salad.
Yeah, that's an interesting email. Okay, so if we're looking at the rally,
it's a great point. I think so we are bullish from a risk perspective.
Yeah.
And I think I'd just back up before talking about metals very quickly. So we went through this decade of the 2010s, which was a very risk-off decade. Right, everybody sort of went close to shore. The U.S. dollar was chronically strong. Nobody really wanted to invest outside the United States, and I think the dominant mindset there was like, let's protect our principal. Right, that's the main objective. Like we've got low interest rates, we've got not many markets participating in a risk on. Since the pandemic, when governments started spending gobs of money on fiscal stimulus, and it continues to this day. Like if you look at the average Western market now. The United States is running 6% fiscal deficits. So there's a lot of money being pumped into the system. That's a very difficult environment to be in cash, to be risk off. And so we could moralize about the aspects of government spending all this money all day long. But the fact of the matter is, I think that mindset, if you will, is shifting from protecting principal to protecting purchasing power, if that makes sense.
Yeah.
And so investors want to cling to anything, whether it's equities, whether it's real estate in certain jurisdictions, whether it's metals. I think that's probably the most important part. And so to answer the question there, generally speaking, we're having a risk-on stance in our portfolios for clients, and we're looking for different asset classes that can protect against that purchasing power, be it metals, be it the copper miners ETF that we talked about, be it different debt structures around the world. Emerging market debt has done really well, for example. That's been able to protect purchasing power. So it's a very different inflationary backdrop. If you go back to the 1930s, there was the word for that, which is the high pressure economy. Growth is running higher than everybody expects. Inflation is running higher than everyone expects, and therefore you need to cling on to assets, right, rather than being conservative.
And another reason to potentially look elsewhere, right? Like look overseas.
Of course.
If we're talking about metals and maybe mining companies, like is there a good place not in the U.S. or in North America that you prefer to look for in that sector?
In the metals and mining sector?
Yeah.
Well, I mean, the ETFs that we buy typically are broadly globally diversified. But I mean, if you look at, that's a very good point, because if you look at international markets in general, like if you look at the All Country World Index, MSCI Index, ex the United States, it's got about 14% materials, industrials, those type of things. In the United States, that's only 7%, so it's half. Wow. But when you look at the broader world, you look at places like Latin America. Chile as an example. We hold the Chilean equity ETF, and that's the largest copper producer in the world. And so you look at the makeup of stock markets around the world internationally, they just have a higher tilt towards old economy sectors, towards raw materials, towards industrials, towards metals, and that type of thing. So generally speaking, if you're in a commodity bull market, you want to be more international. And I feel like I've been doing this for 26 years now. We're going back to that environment, and some of the listeners will remember that we saw in the 2000s, from sort of 2002 to 2012, where emerging markets did really well, commodities still did well, the US dollar was structurally weak, all those types of things. So it's a very, very different environment that we're going through, a regime shift, if you will, Lindsay. And we think we're in that right now.
So interesting. Okay, that is all the time we have today. I appreciate you coming in studio and joining us this morning.
Thank you so much.
Thanks so much. And so thank you to Tyler Morty, CEO and CIO at Four Strong Global, for joining us today. Andrew Bell is next with the Open. Trading gets underway in just over 30 minutes from now, so definitely stay tuned for that.